Hello and welcome to another video on accounting. In this video we will talk about account receivables. Account receivables is an important topic in financial accounting. So I'm going to walk you through basic examples of account receivables, that is when account receivables are created and collected. And we'll also talk about times when the receivables are not collected. So let's start. Mark Hayden is a manager at KRK Technologies, and Ted Decor is the manager at Ted Decor. Mark is calling Ted to order some furniture. So Mark wants $10,000 of furniture for his office. Ted is going to say, sure, let me load up the truck. So now he is sending the goods or the furniture to KRK. And a few days later, Ted sends the invoice. So when Mark gets the invoice, someone in his company is going to record a journal entry by debiting furniture because they got the furniture. And since KRK is not paying them on the spot, so they have a payables and they will create accounts payable. The accountant at Ted Decors is not receiving cash immediately, so KRK will be a receivable for Ted's Decor. So they will debit account receivables and will credit sales revenue because a sale happened. So that is how account receivables are created. Now, a few days later, Ted is calling Mark to ask about the payment, and Mark is going to pay. So Mark sends the $10,000 to Ted Decor. So the accountant at KRK Technologies is going to debit accounts payable and credit cash. The accountant at Ted Decor is going to debit cash because they received the cash and will credit account receivables because now they no longer have KRK as receivables. So account receivable will be credited. Now, most businesses, just like Ted Decor, sell on credit. That means they allow the customer's time to pay. So in this case, Ted Decor is giving 30 days to Mark to pay the invoice. And we call this a credit facility. So Ted Decor is offering credit facilities. Now, why would Ted Decor offer credit facilities or any other business do that? Well, there are advantages to both the seller and the buyer. The seller will increase their sales because most customers might not have cash with them at the time they want to buy something. So if it's a cash only policy, those customers will not purchase. However, if the business is offering credit facilities, those customers will purchase and thus the sales will increase. And a business will be forced to offer credit facilities, particularly when the competition is offering it. And what is the benefit for the buyer? Well, again, flexibility, because they might not have the cash to buy, so they might not buy at that time, and that allows them to buy now and pay later. So there are benefits of credit facilities both to the buyer and the seller. However, it comes with cost and cost to the seller. For example, one cost would be the cost of maintaining credit department. Now, the job of credit department is to assess whether the customer will be able to pay or not. So somebody there has to monitor the customers and run some financial background checks whether they will be able to pay or not. So that involves cost. And when you allow people to pay, they might not even pay. So that becomes something of a cost to the seller also. So that will be a loss of money, loss of profit, loss of goods, and everything there will be. Those are the losses. So operating a credit facility or providing a credit facility has both advantages and disadvantages. So we understood the example of when a receivables is created. So what is a receivables? A receivables arises when a business makes a sales or provides services to a customer on credit. So when a customer buys something but does not pay you on the spot, that becomes a receivables. A receivables is generally collected within 10 to 60 days, depending in the type of industry the business is operating. So a receivable always is on a credit. How is receivables reported on the balance sheet? Well, the receivable is an asset for the business. So it will be reported on the balance sheet as a current asset. So for the Home Depot balance sheet, receivables is reported under the current assets. And remember that the amount that is reported, it will always be net realizable value, or simply called net amount. What is a net realizable value or a net amount? It is the account receivable less any amount of expected non-payment. Now, when we sell to customers, um, oftentimes we might not get some of the receivables. So that becomes non-payment, and that is usually expected in the business. And so the amount on the balance sheet will be the receivables less any expected non-payments. Now we are going to talk more about what this expected non-payment is. In fact, the rest of our video will be about the expected non-payments. So here's an example to help you understand that. James is a customer and he wants to buy a leather office chair. So Ted agrees, and on November 25th, he sends the chairs and sends him an invoice to pay later. The invoice is for $1,400. So when the sale is made, the accountant at Ted Decor is going to debit account receivable $1,400 and credit sales revenue $1,400. Let's take another example. Fiona also wants to purchase some filing cabinets, and again, Ted Decor agrees and sends the goods to Fiona along with the invoice of $3,000. So Ted has completed the sale, and the accountant department is going to debit account receivables, credit sales revenue. A debit to account receivables means neither James and nor Fiona has paid so far, so it will be an account receivables. Now, Ted Decor is calling James for the payment. So a month later, Ted Decor wants the payment from James, but the James can no longer be found. He's not picking up the phone, so he can. That means he's not going to pay. So it becomes a bad debt for the business. So what is a bad debt? A bad debt is a customer's debt that cannot be recovered. So since Ted Decor cannot get the money from James after repeated contact and everything they could do to find him and to pay him to get him to pay, they can't. So that becomes a bad debt for the seller, which is Ted Decor. Now, when a customer does not pay, what should the accounting department at Ted Decors do? Well, there are two methods. One of the methods is to what we call a direct write-off method. Businesses use this direct write-off method when the amounts are small, negligible, compared to the size of the company. So and if the bad debts is not very a regular part of the business. So a direct write-off involves debiting the bad debt expense account and crediting the account receivables account. So the non-payment by James, if accounted for under the direct method, direct write-off method, it will be a debit to expense, we call bad debt expense, and a credit to receivables. Now, businesses generally don't use direct write-off method. So I'm going to illustrate what methods they use through continuing the example with Fiona now. Now on December 20th, Ted calls Fiona for the payment and asks Fiona to pay. Fiona says she's going to pay half of the money. So she pays half of the $3,000 to Ted. When Ted gets that money, he is going to debit cash, and this is coming from a receivables, so we'll credit the receivables. Now, it is now 2024, and Ted Decor found out that Fiona cannot pay the rest of the money. So that means it has become a bad debt. Fiona's $1,500, Ted cannot recover. So it's a bad debt expense. So what to do now? Well, we learned that maybe we could make that same entry we did with James to debit the bad debt expense account $1,500 and credit the account receivables $1,500. But we can't make this entry. Now the reason is because the sale to Fiona was made in 2023, and the fact that we found out that she cannot pay us the money, and we found that out in 2024. So the expense of that sale cannot be in 2024. Sale was in 2023, and the expense of that sale cannot be recorded in 2024. Reason is because of the matching concept in accounting. Matching concept tells us that we need to match, that is to record the expenses in the sales in the same accounting period. So that means if you are recording the sales in 2024, any expected non-payment or must be recorded in the same period as of the sale, which is 2024. So so that is the important thing. And to illustrate that example one more time, let's look at this example. So Ted Seller is selling to his customers and allowing them time to pay. So Ted thinks that I have a feeling that some of you won't pay me, but who would that person be that won't pay? Now he's asking question, is it going to be this customer, that customer, and so on. He does not know um, who pays. So there are so many customers, and how to know who won't pay? And Ted wants to record the bad debt expense in the same year as a sale. So here is the problem, right? Since matching concept tells us to record the bad debt, the non-payment in the same year as sales, but we don't really know which of the customer won't pay us. We only know when time has passed. So so the answer is we don't know, and we can't wait until we know for sure who of those customers will not pay. So what to do? Now we need to record the expected non-payment expense in the same year as sales. We did the sales, we need to record the bad debt. So accountants have come up with a method called the allowance method. This is the method that most companies use, and the one that will be discussed further in this video. So what is the allowance method? Now, since we don't know exactly which customer will not pay us, what the businesses do is at the end of the period, they estimate the amount of bad debt expected from that year's sales. All businesses will have some bad debt. So they might have an idea of how much of their receivables will not pay them. 1%, 2%, half a percent. So they have that expected. So they are going to estimate the amount of bad debt. That is the allowance method. We can't wait until we know exactly who will not pay, so we need to estimate beforehand and then make the entry debit bad debt expense with the estimated amount, and we will credit the account allowance for doubtful accounts. So the first account, the bad debt expense, is used to record the expense, and the second account is used to record the allowance for the bad debt. Since we don't exactly know who will not pay, we cannot credit the receivables, so we will credit the allowance for doubtful accounts. Now the question is, okay, I understood that bad debt should be debit and allowance should be created because we don't know exactly who will not pay, and we should be recording the expense in the same year as the sales. But the problem is, how do we know the amount? Well, the amount is going to be estimated using one of the three methods. So let's look at those methods. Now the first method is the percentage or percent of sales method. Then the second method is the account receivable method, where we use two techniques or two methods, the aging of account receivable method and the percentage of account receivable method. Remember, we use these methods to find out the amount of expected non-payment, or in other words, the amount of bad debt. So let's look at each one of them. We will start with the percentage of sales method. Now, this is called the income statement approach. Why? Because we take figures from the income statement to calculate the expected bad debt. Now, the figure that we take from the income statement is the credit sales figure. So we calculate the bad debt expense as taking the current period credit sales and multiply that by the expected bad debt percentage. Every business has a percentage they think they will not recover their receivables. So we will use that, and that will give us the expected amount of bad debt expense. Once we know that, we are going to debit the bad debt expense with that amount and credit the allowance for doubtful accounts with that amount as well. So again, expenses recorded in the same period as sales, so debit, and a credit would go to allowance for doubtful account since we don't know exactly which customer will not pay us. So we create an allowance, and the amount is estimated using the sales method. Let's look at an example. Bourbon Inc. has net credit sales of $180,000 for the year 2023. As of December 31st, 2023, its total receivables are $65,000. Bourbon uses the percentage of sales method to estimate the bad debt expense. So based on past experience, it thinks 2% of its sales will not be collected. So we need to determine two things. What is the bad debt expense amount, and what would be the journal entry to do? So we know from the question that the company uses the percentage of sales method, in which we do what? We take the current period credit sales, which is 180,000 given to us in the question, and multiply that by the expected bad debt percentage. Bourbon thinks that 2% of its sales will not be recovered. So that is 2%. So 2% of $180,000 will give us an expected amount of bad debt as $3,600. So we know the amount now. Let's make the journal entry. So you know that the journal entry is going to be to debit bad debt expense and credit the allowance for doubtful account, $3,600. Now that is the percentage of credit sales. All you need to do is find the credit sales amount multiplied by the percentage of expected non-collection, and then that will, in the journal entry will follow. Now the the method that most companies use is the account receivables method. Now, in this method, what we do is that we are going to take, by the way, there are two methods of the account receivables. One is the aging of account receivable method, and the other is the percentage of account receivables. So we will talk about the aging of account receivable method. In this method, the account receivables are grouped in terms of how long they are due. In other words, we are going to create age groups for the receivables. Some receivables we might not have collected within might be age 30 days because we haven't collected them for 30 days now. Some would be 60 days old, 90 days old, and so on. So we need to create age groups. Now, based on each age group, we or the business will have an expected percentage of bad debt expense. So those that are in 30 days age group, that means those customers, we still have time to recover from them, so they might not be any. But those that are in 60 days might indicate to the company that since they are 60 days old, the customers are unlikely to get to pay, and they will come up with a percentage, say 4% of them will not pay. And if any receivables are in 90 days, that means customers, businesses now near certain that they will not pay, for example, so they might use a different percentage of expected bad debt. Let's look at an example. Now, the first step in aging is that you need to list all your customers with their balances. Second, we need to group those balances again age-wise, how long they have been due. So for borrowing tools, they owe us $20,000, and that $20,000 is within 1 to 30 days. Meaning we made a sale and in the last 30 days to Baring Tools, so that the age of that receivable is between 1 to 30 days. Same is true for Calgary Drills. Seal Coating Inc., for example, is their receivables is one of them is between 31 to 60 days, another is between 61 to 90 days. So which means that the $3,000 we made a sale sometimes more than a month ago, so that will be between 1 to 30 days. And the 5,000 sale was more than 2 months ago, so that will be under that group, and so on. Now we will total those groups here, the age groups, we will total them. And then for each group, the company will have an expected percentage of bad debt. And that will indicate the likelihood of its non-collection. So this company has 1% expected bad debt for any business for any amount that are due within 1 to 30 days. 2% is for the age group of 31 to 60 days, and 5% and 90% for over the 90 days. So once we have this, all we need to do is now calculate the allowance. So we'll take 1% of 30,000, that's 300. 2% of 3,000 receivables which are between 1 to 31 to 60 days, that will give us 60. For 61 to 90 days, we'll get $700. And the receivables that are due over 90 days, we'll take a 90% of that will be non-payment. That comes to be $900. So this is the allowance amount that we have. And the total of that will come to $1,960. Now, once we know the total, we need to make the journal entry. And this is going to be the journal entry here. Again, debit bad debt expense $1,960, and credit would go to the allowance for doubtful account $1,960. Just to remind you that this is the balance sheet approach because we are looking at the account receivables and group them as to how long they have been due. And for each group, we come up with a percentage of bad debt, and then we will calculate the bad debt. Now, the third way, which is the to calculate the expected allowance, is again the receivables method, the percentage of receivables method. And in this method, we are going to again take the account receivables because this is a balance sheet approach. So we take the period end account receivable values from the balance sheet and calculate the expected amount of bad debt. And how do we do that? Well, we take the period end account receivables. It could be at the end of the month if you are calculating bad debt expense on month-to-month basis, or it could be at the year end if you are doing it, if you're doing the bad debt expense entry at the year end. Anyway, but you will start with the period end account receivables multiplied by the expected bad debt percentage. As once again, every business has some sort of bad debt expense, so they have a percentage for that based on their experience, and that will give them the estimated bad debt expense. And then that will be recorded as debit to bad debt expense, and credit will go to the allowance for doubtful account. So how do we determine the amount of bad debt? Okay, so here's how we do that. The first thing is that we need to calculate the amount of bad debt expense using the method that we just discussed, and minus from this amount any unadjusted credit balance in the allowance for doubtful account. In other words, any previous amount that we have in the allowance account. In other words, any previous bad debt expense account that we recorded earlier. And that will give us the bad debt expense for the current period. So looking at the first box, to calculate the current year bad debt expense, we are going to take the period end account receivables, multiply that by the bad debt percentage, which should give us the estimated bad debt expense for the current period. We will then take a look at the prior balance and minus that from this amount to give us the bad debt expense for the current period. And that would be the amount we will use in the current period as a expense. So the entry is the same: debit bad debt expense and credit allowance for doubtful account. Let's look at an example. Adorable Junior Garment uses percentage of receivables method to determine its allowance for the month of June 2020. So on a monthly basis, this company wants to calculate the allowance for doubtful account. And it thinks that 2% of its receivables will be uncollectible. Its June 2020 balance for account receivable is $50,000. So we need to calculate the amount of expense, bad debt expense for June 2020. Now let's do that. So we know the formula is that we need to find out the required balance in the allowance for doubtful accounts and minus the previous balance that we have. That will give us the bad debt expense for the current period, which is June 2020. So how do we calculate the required balance? Well, again, we are going to take the account receivables, the year-end receivables, which is $50,000, multiply that by the expected bad debt percentage, which in the question tells us is 2%. That will give us $1,000 to be the required balance in the allowance for doubtful account. So our allowance account should have $1,000. We are going to compare this with the previous balance, which will be subtracted from this balance. But since it is our first month of creation of the allowance, there is no previous balance. So it's a zero, which means that our expense will be $1,000. Once we know that expense, that is our bad debt expense amount, and for that we need to make a journal entry. And this is our balance for the doubtful account, which in the first month is the same as the bad debt expense. And finally, let's look at the journal entry. So bad debt expense will be debited for $1,000, and the allowance account for doubtful account will be credited $1,000. So this was month number 1 and how we calculate how we find out the bad debt expense for that month. We will take this same example and continue it into another month, July, to tell you how we come up with the second month of the bad debt expense. So this is the same example but continued. A durable junior garment has an unadjusted credit balance of $1,000 in its allowance for doubtful account. You know that because we just calculated that allowance account. It uses the percentage of receivable method to determine its allowance. Okay. And it thinks that 5% of the receivable will be uncollectible. Its July 2020 balance for account receivable is $85,000. So the company uses percentage of receivables. That means we will use the account receivable amount, which is $85,000. Multiply that by the 5% to give us the balance for the allowance account. So let's look at that. Now again, we'll take the required balance in the allowance for doubtful account minus the any previous balance in the allowance account, and that will give us the current period bad debt expense. So let's calculate the required balance first. As we know, we take the account receivable amount, which is 85,000 given in the question, multiply that by the expected bad debt expense, which is 5%, and this will give us $4,250 as the required balance in the allowance account. We should have this much amount as the balance in our allowance account. Now let's minus the prior balance, which if we have. In our previous example, it was month number 1, so we did not have that. And now, since we have moved to the second month, which is July, we do have the prior balance in the allowance account, which should be $1,000 for June. That will give us expected bad debt of $3,250. So we need to have $4,250 of allowance in our doubtful account. Since we already have $1,000 there, we need to increase it by the bad debt expense amount of $3,250. And so the journal entry would be to debit the bad debt expense $3,250 and credit the allowance for doubtful account with the same amount. The 1,000 already in the allowance account plus the $3,250 will take the balance to $4,250. So we looked at the first month when there was no prior balance in the allowance account, and then we looked at the second month, which is July, and in July we had a prior balance from June of $1,000. So we calculated using this method here. All right, so that was about how we calculate bad debt expense and how we find out the amount and how we do the journal entry. So the important thing for you to understand is, okay, how to calculate the amount and what would be the debit and the credit. So let's help you understand another concept related to this. Now, when TED sells to these customers, right, TED knows that which of these customers will pay, trying to find out which of these customers will not pay. So we keep asking question, who is not going to pay? Since he does not exactly know who will not pay, he is going to record an allowance. We just looked at that, how to do that. But sometimes after Ted has created allowance, he finds out that it's Bob that will not pay. So he finds out the customer that will not pay. Obviously, later on you will know the exact customer that will not pay. But at the time of sale, you didn't know that it was Bob that will pay. Oh, that will not pay. So here. So when we find out exactly which customer will not pay, what we need to do is that we need to make a write-off entry. Since we already created an allowance for it at the time of sale, later on when we find out the exact customer that will not pay, we just have to write it off. And to do that, we are going to debit the allowance account, the allowance for doubtful account, $500, And now that we know that the exact customer that will not pay us, we will create account receivables. So $500 was the amount Bob, we found out, will not pay. So we wrote it off. This is called writing off the amount that we find out for sure will not be receivables or will not be collected. Okay, this is called the write-off. Now, an interesting thing can happen is that a few months later, it's Bob that is calling. And he is sorry that he did not pay the amount that he owed. And he says this is now how he was raised. So he is sending Ted the money, $500. Now Ted is happy that he got paid, but he has a problem. Now, what is the journal entry? So if you remember, we just talked about the fact that Bob was written off from the receivables. So how should we do this entry? Well, there is a two-step process. Now, the first step is that we need to reverse the write-off entry that we just did. And in the second step, we need to collect the cash amount. So the first entry was when we wrote it off was to debit the allowance for doubtful account and credit the receivables. We need to reverse that, which means change the debit place and the credit place. Okay, so the entry would be to debit the account receivables because that was credited in the write-off, and credit the allowance for doubtful account because this was debited in the write-off. So this entry will reverse the write-off entry, which means we are going to reinstate the amount as a receivable in our records. And once this receivable is back on our list, we are now going to make the entry for collection of the cash. So debit cash $500 and credit will go to the receivables. So this is how you deal with a write-off and how a customer that was written off, the balance was written off, comes back to pay us and how we deal with it. So we talked about quite a few things in this chapter. What the receivable was, what is the basic journal entry when the receivable is created, when the receivable is collected. And we also looked at the fact that when a customer does not pay us, what should be the entry and what should be the amount, how we calculate the amount and how we going to do the journal entries. Now, watch this video again. One time might be too fast for you to know everything. So pause the video as you watch it so that you can concentrate on each point. And I hope this video was helpful. Remember to like, subscribe, and click the notification icon for more videos on the channel. And I will see you in the next video.